welcome to Market Week in Review for the week ending May 31st, 2024. I'm your host, Michelle Bajargal, and today I'm joined by our Chief Investment Strategist, Paul Eidelman. Paul, thank you for coming in.
Yeah, happy to be here.
Great. Well, let's start with equities. We're getting towards the tail end of Q1 earnings season globally. So what are some key takeaways that you can highlight for investors based on the results so far?
Yeah, I think generally speaking, the results have been strong globally. In the United States, for example, we're tracking around 11% earnings growth for the S&P 500 index in the first quarter, which is well ahead of consensus expectations about a month ago. That growth is predominantly driven by the mega cap technology stocks, the Magnificent Seven. They've had phenomenal results in the period, including NVIDIA, which has been at the center of the excitement around artificial intelligence. They did very well last week, both in terms of delivered earnings results and positive guidance as well. But in addition to the Mag 7, if you will, we've also seen an encouraging stabilization and broader corporate profitability across the United States, where the S&P 493, if you were to exclude those big seven stocks, is also back to positive earnings growth again, and we're seeing some stabilization in smaller cap company profits as well. So I think a broadening out, if you will, in terms of fundamental strength in the United States. And when you go globally, that message generally translates in Europe as well. There have been meaningful positive surprises. So I think the first quarter globally has been a period of fundamental strength for the global economy and global markets.
So then moving from stocks to bonds, bond yields have been volatile this week, and generally have been higher since mid-May. So what are the key things that are driving these moves?
I think non-U.S. markets are actually probably a bigger driver of what's happening to global treasury yields than the United States. Since mid-May, we've had some pretty meaningful upside surprises to inflation rates in the UK, Australia, and this week, Germany as well. And so that's caused investors, particularly in the UK and Australia, to question when those central banks will be able to start cutting interest rates. So that timing's been pushed out a little bit. In the United States this week, there was a weaker Treasury auction on Tuesday, so not quite as much demand for the new bonds as expected. That caused also a bit of a bear steepening of the U.S. yield curve. But be careful of over-extrapolating that as well. We've just come off the Memorial Day holiday in the United States, and liquidity is always a little bit lower following U.S. holidays. So I think the main message fundamentally is a little bit more non-U.S. in the recent period with some hotter inflation data. In the U.S., I think we're still of a view that we're on a sort of disinflation path over the course of this year. And we think over time that should allow the U.S. central bank to start cutting interest rates. Our view is that could begin in September, and that's roughly in line with what's priced into fixed income markets right now.
Well, that's all we have for today. Thank you for joining us, Paul, and thank you for tuning in. We'll be back next week.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.